So today I'm going to take things on a pretty hard right turn. Actually, I'm going to close the door. My wife had a kid 3 weeks ago, so I'm at home a lot more than I normally would. Normally I'd hang out in my office, but today I'm working out of my home office, so I got to be a little quieter. So today we're going to talk about trading calendar and time spreads in options. And let me start off by talking about my favorite subject, which is me. Nobody likes talking about me more than me. And as Renee had said, I was a floor trader for about a decade. I then left and started Option Pit. Option Pit is an education and consulting firm. So we work with retail traders, helping them understand how to trade options professionally. And we teach you a professional approach. So we teach with an eye on risk management, let's say. Then with the institutional side, we will do consulting work where we'll stress test, implement, or optimize option strategies. So we'll help money managers, fund managers, asset managers, you name it, implement option strategies, optimize their option strategies, or stress test them. We also do a little bit of other types of consulting on the side. In addition, I do trade professionally for a living. I run a hedge fund called Carmen Line Capital. So today we're going to talk about what is a calendar spread, trades a calendar spread share similarities to, how a calendar can tell market sentiment, what makes a good time spread or calendar, and how to use term structure to an advantage. And then I'm going to give you my calendar checklist, and I'm going to show you how to choose the right calendar. And then if we have time, I'll go digging for one. We may or may not. So let's begin. A calendar is the buying of one option against the selling of another option. There are calendar spreads in futures as well. One can do a calendar spread in something like corn, where they buy old crop and sell new crop, or vice versa. But when I talk options, we're talking about selling an option and buying an option against it. So in general, a calendar is really a volatility swap. A trader buys premium in a contract that is in relative terms cheap to the option being sold, or if they want to short the time spread, we're not going to really talk about that. The trader sells premium in an option that is in relative terms expensive to the option being bought. Different terms can be bought or sold, or trade across multiple terms and multiple strikes. There can be really, really complex calendar spreads, but for the most part, most of them are most traders in terms of the retail are going to be used to just kind of plain vanilla calendar spreads. Buying a longer dated option, selling a nearer dated option. So a long calendar, which is what most of you are going to, if you're going to trade these, are going to trade, sells a near-term contract. It can be a weekly, it can be a monthly. It is the near-dated contract that is sold, and it buys a longer-dated contract. So one could sell a September option and buy an October option. One could sell a weekly option expiring on Friday and buy next week's option. One could do dailies against each other. The product produces a trade that is hoping the underlying doesn't move much, but the perception of potential movement might increase. All right, this is called being short gamma. So you're short, when I say short gamma, what I mean is you're short exposure to actual movement. All right, so call it being short kinetic energy of the stock. All right, and then you're long vega in Greek terms. Think of that as being long potential energy. So you own potential energy and you short kinetic energy, right? Or you short movement and you go long potential movement. This is what a calendar looks like in the SPX. This is the S&P 500. This is a This is a July versus a August contract. So this is what standard S&P 500 calendar spread might look like. So now let's talk about the risk. Traders are willing to trade calendars all the time. All right, they might be less aggressive if they knew how similar the risk profile was another type of trade that traders seem to like. The straddle. So straddle is when I sell a call and a put on the same strike. And it is a very popular institutional trade. It is a less popular retail trade. But if you look, it actually looks pretty similar. There's the straddle. There's calendar. So a long calendar, so when you buy a calendar spread, you really just short a straddle and then hedging it. That is all. Whereas a short straddle has limitless risk. Okay, notice this trade will, if the S&P drops, it loses money forever. If the S&P rallies, it makes money forever. Whereas a short straddle has limitless risk, a long calendar is limited to the cost of the spread. That said, around the money, so near where the strikes are centered, the two can behave quite similarly. All right. The major difference is the vega in the calendar, though. All right. That long vega will provide a cushion in a sell-off. However, if the underlying rallies, the calendar actually has the potential to drastically underperform a short straddle. So if I own a calendar and the underlying drops, I get a cushion. But if I own a calendar and the underlying rallies, I can actually lose more on a smaller move than I would lose on a short straddle. Even though, from a technical standpoint, that calendar has a lot more risk. So, understanding how the risks affect part of the time spread is the key to managing that risk. All right. And the key to understanding the calendar is to understand term structure. Term structure is going to be the number one thing that drives trading in a calendar. Overall volatility and term structure. Does everybody know what the term structure means? I'll explain in a second. All right. So think about term structure as the relationship between the different months or weeks. And VIX futures bear a very close relationship to how the contract months look in the S&P 500. So this is a picture of the VIX futures from April. And you can see here is April, May, June. You can see that as we get closer to expiration, volatility is dropping off. And then if I pull up S&P, you see the same thing. The closer I get to expiration, for the most part, the lower the volatility. If that's not the case, there may be a trading opportunity. Take here, for instance. All right. When near-term or near-dated term structure, expiring weekly aside, is as such that near-term options have lower vols than long-term options, that is a sign of a calm market. So when you see this structure, this is the standard structure. This is what we have right now. So if I pull up the S&P 500, come on. You notice we've got a little bit of volatility here, but take a look at the term structure here. We go from 7 all the way up and higher and higher and higher. We got a little bit of a kink right around the 23rd, between the 23rd and the 28th. Anyone know why? Why do you think there's a kink there in volatility? Why does it go from 921 to 975 to 950? What do you think? The answer is the Fed. All right, this is when you can see the Federal Reserve announcement is after the 21st and before the 23rd. So using this term structure, I can actually pinpoint when there's perceived risk in the market already. So changing market sentiment. When we have an upsloping term structure, that means the market is loud. There's lots of crazy things going on. All right. During that period of time, we just got done listening to the last presenter talk about Fibonacci's. And she said, it works X percent, 85% of the time. When you have this upsloping term structure, the market is loud. That is when those assumptions stop working. When we have a downsloping term structure like we do right now, that's when the market is quiet. That's when a lot of those assumptions work. All right, if I pull up VIX Central, which is one of my favorite websites. In the world's slowest internet. This is what VIX term structure looks like right now. This is what perceived risk is in the S&P 500. Is the market quiet or loud? Right, it's loud. All right. Now, let's look at historical prices. Here's October of 2018. The market is loud. So when near-term term structure is like that, your assumptions work. So if all you take out of it is paying attention to market term structure will help me manage my assumptions and my market approaches, mission accomplished. But these calendars can be really nice trades. All right. So I'm going to be discussing the long calendar only and how to execute it. There are two keys to a long calendar. Overall volatility of the underlying and term structure. They're going to determine everything, whether you make money or not. Those two forces produce a high or a low price on a calendar. So if I'm buying a calendar, do I want a high price or a low price? All right, you want a low price, correct? Exactly. You want to buy low and sell high. Same for calendars. So if you have a good term structure and a low overall implied volatility, your chance of winning on calendars are going to be really good. So as a calendar is long vega, the goal of the trader should be to buy the cheapest implied volatility as possible. This is going to cause the overall price of the calendar spread to be low at the time of purchase. Look at where the IV is in the cycle of the current trade. Right? Implied volatility really moves in 4 cycles. All right? Zone 1, which is kind of low volatility. Zone 2, which is low normal. Zone 3, which is slightly elevated, and then Zone 4, which is elevated. And 70% of the time, options are in Zone 1 or Zone 2. 25% of the time, they're in Zone 3. 5% of the time, we might get into Zone 4. Zone 4 doesn't last very long. So when buying a calendar, the trader should be looking for a flat or positive term structure, or at a minimum, relatively flat to where the overall term structure has been. So what I mean by is you want the volatility you're selling to be more expensive than the volatility you're buying, or at least relatively close. Unfortunately, when implied volatility is low, the market is smart and makes up for it by making front near-dated stuff more steep than longer-dated stuff. That term structure we talked about. The quiet market. Getting a positive term structure against a low implied volatility is going to be the best way to set this stuff up. So when you buy low implied volatility options, they have the most gamma. That means when you buy a low volatility, you're getting the most kinetic energy for the buck. You're also buying cheap potential energy. And when you sell a higher IV, it will actually have less price sensitivity. All right, and that'll lower your Greeks. It'll adjust down your perceived risk. So when you buy low IV options, they have the best ability to benefit from an increase in implied volatility. And when you sell high IV options, they're more insulated from an increase in implied volatility. It lowers your vega risk and it lowers your gamma risk. So if you get a flat term structure and low implied volatility, all of your risk parameters are going to be lower. That is where you start hitting these ones out of the park. That's where your win percentage really increases. You mix this approach with any type of technical analysis, and you can set up calendars that can do extremely well. So realized volatility. Actual movement is the big risk in calendars. So you want to make sure that the trend is lower. Movement should be falling, not increasing. Right, that's key. All right. Look for events that might hold up IV in the long term. Things that could raise implied volatility. All right, so in a second, we're going to look at bond vol. I'm going to talk a little bit about that, and we'll go from there. So you want IV lower than HV, but HV to be sinking. All right, and if you can't get an implied volatility lower than historical volatility, you at least want low and sinking or stable movement exposure. All right, now let's talk placement. Calendars can be placed at any different contract month. Weeklies, monthlies, long-term, it doesn't matter. Find an option with a low IV, a low implied volatility. Then find the 2 months that trade best against each other. I don't care what you do. If you trade calendars and you trade positive term structure and low implied volatility, and you pick the best contract months and you avoid event risk, you're going to be in good shape. Right? So one thing to be aware of with event risk is things like earnings. Earnings can create a positive term structure and a low implied volatility, but you also might be selling an earnings contract, which you might not want to do, or you might sell a Fed contract. So you have to be careful. So for a directional calendar, you want to make sure that one is setting up this beyond where one might think the underlying could go. In addition, directional calendars kind of stink for bullish trades, except in the lowest of implied volatility environments. Right, so in this environment, I don't mind bullish calendars. But when the VIX is above 14, almost none of my calendar spreads are going to be bullish when I've got a directional pick. All right. It can also be great for illogical trendy stocks, names like Fitbit or Tesla. Calendars can be awesome for it. So now here is my checklist for calendar. What IV cycle are we in? Are we in zone 1 or zone 2, zone 3 or zone 4? As a rule, you never do calendars in zone 3 and 4. In zone 2, you want to do at the bottom of the zone, not toward the top. And you have to have been consistently in zone 2. And in zone 1, where we are now, you can kind of do calendars whenever you want. And if you want to think, if you want zones for VIX, think anywhere below, think anywhere below 14 is zone 1, or maybe 13. Think of zone 2 as anywhere below 15. Zone 3 is going to be kind of 16 to 20. And zone 4 is going to be anywhere above 20. So now, where is the implied volatility within that cycle? Is it the low end or the high end? And are we in a cycle switch? What has movement been like? Is movement sinking or is movement increasing? All right. What does term structure look like? Is it positive, flat, or in a contango? And then finally, do my assumptions hold up? If my assumptions change, one of the mistakes I think a lot of traders make is that when their assumptions change, they don't get out of trades. All right, so if you put on a trade based on a set of assumptions, and that trade loses, fine. If that trade wins, great. Now, if you put on a trade and one or two of your assumptions changes, so you assumed that we were going to stay in zone 1, or you assumed we were going to stay in zone 2, and we switched to zone 1. Well, the low end of zone 2 is what? The high end of zone 1. Your assumption changed. Get out of the trade. So if your assumptions change, exit. All right, so if Britain votes to leave, or if if something is wrong, get out. So now let's look at a trade. So here's TLT. This is one that I like. Why? Well, take a look. Movement is sinking. This light blue line represents 20-day. And this is from today. I literally pulled this up 20 minutes ago. This is 20-day historical volatility. It's sinking. The IV, we are in zone 2 for bond vol, and we're at the low end of zone 2. Especially considering we have what's coming up later in the month? Federal Reserve. The underlying, range bound. It's a good looking calendar spread. Either the 139 or the 140. Look at the term structure. So you can see the yellow represents standard September expiration on the 16th. The green is the 23rd, and the blue is the 30th. So if I was going to do a standard calendar, or if I really if there was no Fed, if we didn't have the Fed coming up, what contracts would I want to buy, and what contract would I want to sell of these three? What combination? Right, I would want to sell the 23rd and buy the 30th. Take advantage of that term structure. Now, we have the Federal Reserve coming up, though. So looking at the term structure, I may want to sell next Friday and buy the 30th. So I want to buy the light blue and sell the yellow. This is one of those cases where I'm willing to accept a negative term structure. So if I pull up TLT here, let's look at the actual implied vols. Looking around, clearly, of the longer dated stuff, I want to own September, '30th, or the regular October. One of those two. And I'll sell September. I don't want to deal with the Fed. I don't want to be short into Janet Yellen. All right, do I think they're going to raise rates? No. But do I think that they have a clue? I do not. When the FOMC shows up for their meetings, they arrive in a clown car. I don't know if you knew that. And so you never know what they're going to do. So I don't want to be short at the 23rd. So I'll sell September and I'll buy relatively inexpensive volatility at the SEP 30 or OCC. In this case, I'm doing September 30. So the trade I came up with, in this case, was the September 30, long calendar, paying 70 or 71. That's cheap. The nice thing is, all right, I can put this thing on, and if we stay range bound until the Fed, I'll make a lot of money. Now, here's an alternative. I'm going to convert this to just at the money, +1. So one thing I will do instead of a standard calendar is a straddle swap, which is the same thing as a calendar. So if I sell the September 140 straddle at $2, and I buy the September 30 for $340 or $342, I pay for that calendar twice. Now, here's the advantage of doing this as a straddle swap, especially in front of events. Let's look at the risk chart here. The advantage is after this September rolls off, I'm left with this position. But I'm left it discounted by $2 from the straddle I had short in front of it. So I end up with an extremely inexpensive look at the Fed. So I can work my way into trades and positions that can be really beneficial to me into events. And this is what my risk on my trade looks like. Notice this is shows a 10% increase in implied volatility. So if we increase volatility by 10% and we drop 2%, I don't lose very much. Same thing on a rally, but if we sit here and volatility increases like it might, this is tomorrow's numbers, by the way, I make 70 bucks just sitting here. So understand how calendars are like straddles, understand the risk and warning signs of term structure, learn to recognize the checklist for a good calendar, and look for the best trade. Now, quickly, I'm offering a trial to my chat room. It's normally $125 a month. Today it's just $17. And it's for 1 month. And here's what you get. You get access to our strategy letter where we follow trades. You get access to our chat room where we have people in all the day. Myself, the people that work for me that are also professional traders, and my own kind of high-end students. All right. And here's the best part. Once a month we do a special Saturday class, and we sell those individually at 170 bucks. And then if you want to buy them recorded afterwards, they're more like 300. This month we're doing a class on daily options. Daily options. All right, and it's going to be a 2 to 3 hour class on daily options. It's free because subscribers to Option Live at the $125 level actually get these Saturday classes for free. Now here's the best part. After your $17 trial rolls over, it's just $97 a month instead of $125. So you get a discount forever. But this first try, literally just 17 bucks. It's kind of a how can you lose on 17 bucks. That is less than, I mean, I took my wife and my son for frozen yogurt, and it cost more than a 1 month trial to option here. So that was eye-opening to me. All right, do we have any questions, or do we have any stocks that you want me to look at in terms of setting up a calendar? All right, I've been told I've got about 5 minutes. They want to get back on track, so we're going to try and get the next presenter going by 3:30 Eastern time at the earliest. So does anybody have any questions? Don't use YouTube or Facebook. Can you email me the link to the recording? Why don't you don't use YouTube? I'm sure they can. Do you ever see VIX going higher again? Yes, it will go higher someday. And actually, the thing to recognize is that the market sees VIX going higher, and that's one of the things holding it. And that's one of the things to recognize. So if you buy a September VIX future, you're buying a VIX of 13.2, not a VIX of not a VIX of 1193. How do I structure a decent long calendar using VIX? If calendars in VIX are extremely dangerous because each individual VIX contract is kind of its own individual trade. That's trading calendar spreads in VIX itself is very similar to trading different contracts in a grain, where a June contract may act very differently than a September contract. So you have to understand that the two of them are very different. All right, so now someone wanted to look at, and so how do I construct contracts in VIX? I usually will use, if you want to do a calendar in VIX, use VXX or UVXY, not VIX itself. So let's look at RAIN. It's a Regeneron Pharmaceuticals. All right, and then let's look at here at the term structure here. Set vols. And when I look at the term structure, I mean, we can actually see they don't have earnings coming up. Let me just see where earnings are coming up. They've already had earnings. Stocks is going lower, but it's slowing down. The implied volatility looks like it's in zone 2, but at the low end of zone 2. All right, that's a good question. I'll answer that in a second. All right, zone 2. So it looks like it's at the low end of zone 2. I mean, this would have been a phenomenal bear calendar. After they crushed volatility, this would have been a phenomenal bear calendar spread. So volatility pretty normal. Movement appears to be sinking. And so when I look at term structure, I want to own regular October. I know that. And I would be looking to sell September 30 weekly against it. So if I sell the September 30 weekly, you know, I can either set it up with a direction or I can do a non-directional. So let's try a spread that looks like this. This is a double counter I'm looking at. And then if I do October behind it, $9 for on a $400 stock for a double calendar, $7 wide, is inexpensive. And that's because of that positive term structure. So if I just look at these trades against each other, I want you to notice that I'm selling 34% volatility and 32.3. Widen that out a little bit there. So I'm getting to sell 32.37 and 34.5 versus buying 33 and 32.2. So I'm getting positive term structure, relatively low volatility, and it produces an inexpensive calendar. I like this. It's not a bad looking trade. This is called Live Vol X for Lightspeed. I've got preferred pricing for my clients using it. Mark, how do you repair a calendar gone bad, wrong direction? I'm a proponent of one of two things, either taking the calendar off or buying single options. All right? Especially if the vol is super cheap, buy options. If the vol is expensive, take the calendar off. And when you buy options, you can actually set it up as a strangle. You can have a strangle with a directional delta to it. I will do that sometimes. All right, guys. Again, make sure you check out this trial. It's legitimately $17. That's less than 3 frozen yogurts at Yogan Fruz. You know, you can't lose. All you have to do is email me if you want to and all you have to do is email if you want to cancel. So no biggie. All right, folks. With that, I'll pass it back to Renee. I will thank the Investor Inspiration people for having me. It's great to be here, and I'm really happy I got to present. Thank you.